Thank you for having me today. My name is Valerie Brown. You're going to have Death by PowerPoint. I'm going to cover a lot of things, just talking about our dive into the current state of insurance and the climate we're facing here in California. We're going to touch on strategies for homeowners and communities to mitigate that risk, all related to working with insurance to better serve our communities as we're facing this increased wildfire risk. So I'm going to run through these slides. Don't feel that you need to take a bunch of pictures. There's a lot of information there. I'm going to stop on the last slide, which is my email address, and I will email you the slides. So we're going to touch on these at a very high level, okay? So for United Policyholders, we're a national nonprofit. We've been in operations since 1991. We were formed in the aftermath of the earthquakes in Santa Cruz, responded to the Oakland Hill wildfires, and then we've been doing work in this space ever since. So we work in all 50 states. We're based in California, supported by grants and contributions. And really, we're focused on our 3 programs. We have our Roadmap to Recovery, where most of you see us in your community post-disaster. We're helping insurance people navigate insurance claims process for a couple of years until they finish that and they're back home. We have our Roadmap to Preparedness program. Later on the table, you're going to get 2 handouts. One is dropped by your insurer, which how many people have been dropped? I know that question was asked before, but a fair number of us have been dropped. It's becoming a bigger issue. Information on how to navigate that. Our RAP Resource Center, funded by the LISTOS grant, so thank you, CAWFire, CalOES. And then our home shopping guides, so you'll have that information on your tables later. That feeds into our Roadmap to Preparedness program, which is really where we've taken lessons learned from people who lost their homes in a catastrophic loss and what they wish they had known before the disaster so that they would have been better prepared for this process. And then our Advocacy and Action is where we take those pain points people experience post-disaster, and we work with regulators and legislators to improve the situation for people in the future. And so this is a very complex crisis, as you're seeing. You know, insurer actions, they're in response to this risk. It's not the idea is not that they're raising rates without, and dropping people without justification, right? Climate change is impacting, risk scoring, all of these things are just crushing not only property owners, but also the insurance companies. So there's this crisis going that's just creating this imperative to improve and innovate, right? And so this is what we're seeing in the market with the crisis. Priorities are evolving. You know, prior to 2016, we were really focused on what insurance consumers saw post-disaster. You're underinsured. How to have an inventory, taking away those true pain points. And then with the Tree Mortality Task Force, it changed. People were looking for any affordable insurance option, anything, because as Frank said, it's impacting the economy. And so we have to make that change there. So the bottom line for consumers is this: those options are very limited. That's what our climate for insurance in the state looks like. Premiums are doubling, tripling. I've seen people go from $2,500 to $16,000 in a year. It's an incredible burden, and that's how, you know, them taking the time to get there. And a lot of people, if they don't have a mortgage, they're opting to go bare, which means if a disaster hits, if they're lucky and they get a max grant from FEMA and it's a federally declared disaster, they're gonna have $41,000 to rebuild. That's not sustainable for most of us. With our home being, for most of us, our largest asset, you need insurance. We need to have a very healthy insurance ecosystem. And so these are the steps for consumers. And like I said, I'm not gonna talk all through these. I'm just gonna share them, hit the high points. You'll have the access to these slides later. So on our website, we have information about shopping help. We do webinars every quarter on this just to help people. Please, if you're working with consumers and you're finding they have these issues, share our information so that people get that information. Because what we find, a lot of people don't know what to do. You know, because for most of us, we've had an insurance agent, the same one for 20, 30 years, and when they say, I'm dropping you, we don't know where to go because it's a complicated ecosystem. So current rules, just hitting on this for the state of California, we have 75 days notice now, before they must give you that notice. But the government can't enforce somebody to insure your home. So we have the California Fair Plan. So these are the steps for the rules that, and that lays out for individual consumers what this looks like. So lingo, these are the terms that you need to know if you're shopping for insurance here. Main types of insurance, this is the information for the 4 types that we're talking about. If they're admitted and licensed, they're covered by the California Insolvency Protection Fund. If they're not, you don't have that protection. These not admitted surplus carriers, here are some of the names for that. If you've kept your coverage, you probably don't know about them. If you haven't, these are names you might need to know. And if you're dealing with one of these that you don't know and you need to know, here's a way to check their financial strength, because if they're not guaranteed by the state fund, you're dependent on their financial strength if they do go under. Installment plans, we recommend you try to do that if you can get that. It helps with managing those payments, as we said, when they're tripling. This is the handout that I mentioned that we're going to pass out. These mitigations align very much with IBHS program that Roy will be talking about later. We have a survey. We encourage you to push this out. We've been running this for 5 years now, just tracking what the state of the insurance is for homeowners across the state. So we want to know what people are seeing. Our WRAP project that I mentioned earlier, this is you'll have the larger card will have that on the back. So information about that, it's broken out by county. Please check it out. Shout out to Stephen with Ventura. He's built a very robust site for them. So kudos to Stephen for that. This is our WRAP working group. We meet monthly. I invite you to attend. Please join us, present if we haven't had you before. As I mentioned, OES funded our WRAP Resource Center. Getting back into Firewise communities. You've heard a lot of these things, so I'm just going to flip through these and make sure that I hit things that we haven't talked about today. Mitigation funding, that's one of the things on our WRAP Resource Center that we want to make sure that you're aware of. Cost sharing innovation, you're going to have to be creative. It takes all of us, government, homeowners, insurance. Hopefully we're getting discounts for people, working with your community, being a Firewise community, having a fire safe council. Rewards to incentivize mitigation. These are the types of things we're hoping to see for people as this ecosystem changes and evolves to meet these growing needs. Not going to talk about Roy's program at all. Progress in California. CDI regulations, they set the standards for the rating plans. This is what we're looking at here. These are the challenges remaining. The legislator has been helping non-moratoriums, non-renewal moratoriums help people that are impacted by a disaster. So this is the information on that. Potential solutions. I know she's going to yank it on me in just a minute. And I'm totally into Roy's slide, and my slide with my email is not here. Sorry about that. I will be over at the table, and I will give you that. Give you my card. Thank you. And Roy, you are up.
Thank you, Val. I'm going to try to pull some strings, some of from what Frank had to say, some stuff from Val yesterday, Chief Berlant, in this space, just lay out some key tenets that hopefully will drive some of the conversation that goes on. There are a number of things that drive the insurance realities here in California. Inflation, the value of properties that continue to escalate, so the denominator is changing, some regulatory difficulties that are in place, and a difference in terms of wildfire. But insurers are actually not concerned from a financial perspective if a dozen or 50 homes are lost. It's a bad day for that family, but that's fully priced in. The point of existential threat to them is conflagration. When did we go from dozens of homes to a point by which we have 5,000 homes that are in this space? There's a QR code here that can take you to this recent report we put out, and it actually has a link to all the other stuff that we have published right now. But I want to keep this front and center. Whether it's CAL FIRE, the various fire services, somewhere between 98 and 99% of the fires get put out before they get to 10 acres. We're focused on that 1%, and we're focused on that 1% that gets to the point of conflagration. That's the point that makes for this difficulty. So as we work and do the work on the science, we meet this reality that says the communities are already built. There's some really good work about how to build better on building codes. In another session, I would tell you a whole lot about that and where it goes. But the reality is we're working with communities that already exist. So IBHS is a 501c3 research organization. We do work across a set of perils where they invade and strike the built environment. We've been doing work in the wildfire space. We have a facility just south of Charlotte, North Carolina, the only place where full-scale ember attack in storms can be modeled against full-size structures. The work in terms of how that plays at different wind speeds and the like. We do this because we want to understand this kind of balance of things we can do in the lab as well as what we can do in the field. It produces a set of images because oftentimes people just can't imagine this can actually happen to them, right? They evacuated. They were told to go somewhere else. They don't know what those pieces are. And so we do a lot of work both to understand it and then lay out paths in this space. A lot has moved since 2017, but I do think people understand the power of embers that drive so much of this, as Frank was talking about this morning. But I don't know that most Californians, most homeowners, understand this domino effect that plays. This ignition source that comes in some kind of wildland that then begins a cascade into this space. Yeah, we focus a tremendous amount on the ember side of the equation as well as structure-to-structure pieces, that conflagration element that kicks in. I think this is one of the elements collectively, because this is some of my favorite people are in this room. We've got to help folks understand this. It's the pathway to action is understanding what can potentially happen in that space. And so a number of folks have referenced Wildfire Prepared Home. 4 years ago, we said, here's the set of things that matter in the wildfire space. We were pushed that says, which ones matter most? Unlike things that play out in flood and wind, there's a set of baseline pieces that need to collectively be done. The science is crystal clear on this front. It starts with the roof. Good news is 99.2% of Californians already have a Class A roof, which says roof is not likely to be the point of ignition. If you've got cedar shake shingles on your house, someone is likely going to nudge you to replace them soon enough. There's a set of building features. It is the vents into the attic and the undercrawl space, but also the 6 inches at the very bottom of the wall. That needs to be entirely non-flammable. The good news is, at least for the last 23 years, because of termite concerns, everything in California has been built by which that is the case. Some people may have built it up, but that piece is there. Which then turns us to the elements of defensible space. And defensible space has 3 layers to it, the first 5 feet, the 5 to 30, and then beyond. We look particularly in the suburban context. 5 to 30 needs to be lean and green. The first 5 feet, nothing combustible. Nothing combustible. What we keep watching is there are things that are inside that zone and they can torch out. Most of the time it creates, because of open eaves in California, that then just torches up. I've seen small plants do it. I've seen large plants do it. I've seen green plants do it. I've seen dead plants do it. These various pieces play in such a way that this is an element, as it deals with ember and the low heat flux side of the equation, we need to do this. When these things are done, there is a designation program. It can be inspected and verified, and insurers are recognizing these pieces. Now, people says, well, is that all I need to do? Well, I'll tell you, there is a second tier set of things. They're largely things you can do at the point of new construction, but you could retrofit to these point. They are good ideas. If you do those things, we would give you a designation with a plus on it. But the first layer of pieces are these elements that are in orange that have to be pulled together. As we look at these pieces, this science is something that we have shared very broadly. We collaborated with a whole set of people when the Safer from Wildfire pieces. It is what is inside the place in terms of the regulations that are in play in that space. I'm sure there'll be some more questions about that. But I'll keep reinforcing, there's a whole set of things, and when there's one missing link, we open ourselves up to the fire. My last point, I've been focused on the parcel. There is a community dimension to this as well. I think the science at the parcel level is pretty clear at this point. There's a lot of collective work going on the community side of the equation. I'll put that for you up here in summary, because there's a set of these things that are givens, and there's a set of these things that we think you could actually control. And this is the work that is at the forefront of our research right now. You'll see those pieces. You're not going to change your topography or weather. You're not going to change the broader vegetation zone that you are in, or the kind of density of homes that are already in play. But there are a set of actions at the parcel level, as well as fuels, and as well as the other kinds of pieces that are in play. The collective action is when do parcels meet the pieces that are then dealt with in terms of the community. It is a both and conversation that is here. With that, I'll turn to my friend Matt.
Hi, it's really exciting to be here with you all this week. My name is Matt Wibbenmeyer. I'm an environmental economist at Resources for the Future in Washington, D.C. We're a nonprofit, nonpartisan research organization focused on doing environmental economic research to inform environmental and natural resources policy. Like many of you, we've been watching developments around insuring wildfire in California with a lot of interest. And so today I'm going to share with you some lessons from a paper that some colleagues and I are currently working on, which draws some lessons from previous challenges in insuring natural disasters. So the first lesson is that risk-based pricing is important. Risk-based pricing has come up already this morning, but risk-based pricing is pricing in which every policyholder pays a premium that's commensurate with the risk they face, and therefore the cost the insurer takes on when they choose to insure them. So this is important for two distinct but both important reasons. So there are two aspects of risk-based pricing. There's the overall average premium that policyholders pay, and there's also the relative difference in premium that policyholders pay when they face different levels of risk. Okay, so average premiums are important for maintaining insurance availability. There's no rule that requires insurers to operate in an area. If it's no longer worthwhile for them to provide insurance in an area, they can feel free to withdraw. And so it's really important that the average premium that they're being paid is commensurate with the risk. Relative premiums are important for a different reason. So if relative premiums are not consistent with risk, you can have a situation usually where people facing relatively lower levels of risk are overpaying to cover the risk that higher risk households are facing. So this is not desirable from an equity standpoint, and it also prevents appropriate price signals from being sent to home buyers and developers about the risks of living in a given area. To price insurance appropriately in a risk-based way, insurers need, they need regulations to allow them that, and there's been a lot of discussion about this in California recently. I don't need to go too much into that, but they also need to understand the risk, and there's been less discussion of this, but wildfire risk has escalated so quickly, so recently, that there's still a lot of science out there that's not understood. And we have heard a lot about some aspects of that this morning. But we really need better understanding by insurers about that risk in order to, for them to price it effectively. So the second lesson I'll share is that there's a tension that exists between risk-based pricing and lowering the financial burden on households in high-hazard areas. So a significant challenge is, of course, that while risk-based pricing is important to ensure availability of insurance in high-risk areas, this may in some cases make insurance unaffordable. So I have some previous work that finds that households in high-risk areas in the Western US, and especially in California, are more likely to be high income than households overall. But these areas are really variable, and in many areas there are lower income and more vulnerable populations living in high-risk areas, and some of these populations have been there in these areas for generations. So it's important to address this affordability concern at the same time as we address insurance availability. So this may in some cases call for government intervention, so subsidizing insurance in some areas, or backstopping the kinds of catastrophic losses that Roy just talked about before. And this is something that has been tried in the National Flood Insurance Program. The third lesson is that facilitating investments in risk mitigation is important, but this is also challenging. So as we've talked so much about over the last day, in the case of wildfire, risk is not a given. There's a lot we can do to reduce risk, and in fact, this is the best way that we can address the affordability problem, by actually bringing down the risk that households and insurers are facing. So IBHS has done a ton of great work on things that can be done at the parcel level. We also have, there's great evidence now about effectiveness of building codes, that building codes have substantially reduced the likelihood of structure loss by about 40% relative to homes built before the Chapter 7A law in California was passed. If you're interested in this, I really recommend looking at this paper by Judd Boomauer and Patrick Bayless. It's an accessible paper and really well done. But while we know about how effective all of these various strategies can be, incentivizing risk mitigation activities for insurers does come with some challenges. So for one, there are some challenges in terms of monitoring. Some of these actions that homeowners can take, particularly actions at the parcel level, require almost continuous monitoring, which is very expensive and difficult to do. I heard yesterday about some of the work that CAWFire is doing in this area, which is great, but it's a really challenging thing to do, and it's sort of necessary for insurers to provide some of those incentives. Because I'm running out of time, I'll just briefly go to the last lesson I was going to share, which is also the key role that risk communication can play here. We know from evidence from the National Flood Insurance Program and also from some of my own work looking at wildfire hazard disclosure laws in California that information provided to homeowners about risk can affect valuations of risky properties, so it affects the demand to live in these areas, which could be important, and it may also affect how willing people are to do some of these important risk mitigation activities. But only California and Oregon currently have wildfire hazard disclosure requirements. So this is clearly an area where we can see some improvement in sort of informing homeowners about this risk. So with that, I'll close, and I think we'll do our panel discussion.
So we have a few questions for our panelists, and then we'll take questions from the audience. And I'm going to start with, how can the insurance sector incentivize wildfire resilience? I know DOI had, had the call out for insurers to put their mitigations. We have one on the books right now. California Fair Plan is offering a 15% discount, 10 for the home, 5% discount for the home site itself. So Roy, Matt, what can you share with us there about how that's being handled?
Yeah, so fundamentally, price follows risk. And so there was already a movement in this direction, and then Commissioner Lara expedited it. And so if an insurer uses wildfire as an underwriting criteria, they're required to provide price consideration if a set of actions have been taken. That's what the Safer from Wildfire pieces that are there. 12 of the leading insurers in the state submitted those single issue rate filings in April. The commissioner has not yet taken action on them. Once he does, people will qualify for those pieces that are there. But there's a nuance, though, that becomes important. The average rate for insurance in California is relatively low compared to some other places in the country. If you've had one of those really high rates, you're one of the stories that Val's talking about. But the average price for insurance, in Florida, is $5,500. The average price in Oklahoma for a $300,000 valued house is $5,400. They've got a lot of hail problems, and so they got insurance that ties back to that. I give you that piece. The average in California, and averages, there's always people at each extremes, about $2,000, maybe $2,500. If they get a 10% discount, that's a couple $100. And we're already in conversations that go, oh, but changing the landscaping up next to my house may cost me $3,000. Like, well, when do I get all that money back? We have to help people understand that insurance is a dimension that will nudge them down the road. But you shouldn't think that you get all your money from mitigation back simply in your premiums. Because I've talked to folks who had that $2,000, $2,500, and they're like, you know what, I don't need to do the mitigation. It doesn't pay back. And then they get non-renewed, and they get an $8,000 price from the Fair Plan, and they go, why didn't you tell me? I get it. They made a near-term decision. But we get in these juxtapositions. So right now, those filings are in with the insurance commissioner. People should begin to see that. I think they're going to see more nudging that will play going forward. But always remember, insurance is a piece of the risk. We can't view it as the only way to understand the payback.
Thank you. Matt, anything to add?
Yeah, so kind of zooming out, I'll just add that there are kind of we've talked about two kinds of actions that are important to mitigating risk, and those are actions at the parcel level and actions at the community level. Usually when we're talking about insurers incentivizing risk mitigation activities, it's at the parcel level. You can imagine that this could also be done for community level actions, but there are some significant challenges associated with this because in California, there are over 100 insurers operating. If one insurer chooses to do this kind of thing, it's not likely to do much. You need some kind of coordinated action here, and that might need to come from government. So already in California, we're hearing lots of talk about mandating breaks in insurance for different kinds of actions. This could include community level actions. Another thing I want to add to what Roy was discussing about the size of the risk reduction. So it's really important, if the government was to get involved in mandating insurance breaks, it's important that the size of the break that insurers are offering to consumers, it's important that that's actually commensurate with the risk that is being reduced for policyholders, because if that's not commensurate with the risk, that's going to end up being a cost for insurers that could cause them to leave the state. And that's actually happened before in the case of flood insurance in Florida. So that's an important consideration here.
And that actually feeds into my next question. So you've answered that. And I will say, like with the Marshall Fire, specifically, when there was the chance to rebuild, there were two things they did. They offered energy efficiency grants focused on climate change and that reality to allow people to incorporate better rebuilding practices that benefit energy, water, and wildfire risk reduction. So sometimes you're going to have to think outside of the box, and it's really it's on local government to look for those opportunities to help move the needle with rebates, grant programs, those opportunities they're doing there. Roy, anything to add on the local government side?
Well, I think that local governments always have a really crucial piece. And we talked a lot about the fire safe councils, a lot of work that does on the front side. Memories fade really quickly right after a catastrophic event. And so we watch communities relax their codes under the name of, well, let's expedite rebuilding, which is really about getting their tax base back because they can't charge tax on something that isn't in place.
Right, dealing with underinsurance, and that's the remedy for underinsurance,
right.
Which is not helpful.
And so they work in that direction. We've got to help folks continue down the road. California has the best context for this. The local community can't quite relax those pieces in much the same way as we see in some of the other jurisdictions.
Thank you. Next question is, how can we ensure California residents can actually get insurance? Because it's feeling like it's obviously a struggle, and we're looking at Florida where it's a much bigger issue with much different problems, but it feels like we're going that way.
You know, the insurance world is a competitive space. There's more than 100 insurers. And so as we look collectively at these pieces, when the market is healthy, many people want to give you a price. When the market's not healthy, not as many people want to give you a price. And so it's driven, as I said at the beginning of my remarks, inflation has driven a whole set of pieces up. The value of properties has gone up. You know, so people are quite proud. My home value went up 40% over the last 5 years. You should presume that your insurance price went up by 40%. Commensurate.
Yes, and you should be insured to rebuild that home.
Absolutely, and that's a piece I tell folks, you've got to keep working with your agent on an annual basis and make sure your total insured value is all the way up on that side. There's also a point by which the ability to get rate in California is a very slow process, slowest in the country. I think that the things that were announced by Commissioner Lara last month lay the planks to help move those things in the right direction. But there's a whole lot of turbulence in the insurance market in California before we get to the question of wildfire. And so, but as a consumer, it's not reasonable for them to think they actually understand all of those moving pieces. How do I think we do it? Let's make sure that the risk connects to the price so it is really competitive and people want to compete for you. Let's make sure that there's transparency for folks when they take the actions. They're going to get credit. I think we got to be fair to people. They made the investment. They need to make sure they can connect the dots. Those are the two things I would point to.
And Matt, anything to add? And if you've got a question, if you'll go ahead and raise your hand, we'll bring a mic to you to queue you up.
Yeah, so wildfire is really not fundamentally uninsurable. As Roy said, the challenge is connecting risk to price, and in order to do that, regulations need to allow this, but also insurers need to understand the price. That's going to really, of course, there's challenges with correlated risks and the risk of conflagrations. Reinsurance can deal with that. It's really not a fundamentally uninsurable issue. That said, the price may not be something, when we connect risk to price, the price may not be something that everyone likes and everyone can afford. And so I think that policymakers are really going to have to address those issues separately from one another.
I got a quick question. From a tribal community, we live in a lower income community. We just built houses for a few of our tribal members. We're blessed to have some new houses. The problem is the insurance, trying to find insurance, because it's part of the grant program to have these houses insured for fire, And the problem is we're having now is finding insurance provider to cover without paying exorbitant amount of money, which the tribal members don't have. You know, obviously it's not a option because we had this one plan we had to pay $10,000 for a deductible, and it was ridiculous. You know, it's just, you know, a lot of people can't come up with that kind of money. So what's being done to, because most of the reservations are in the urban area, high brush, you know, a lot of shrubs, stuff like that. But what is, and then the insurance that we had for 10, 15 years that I've had, they dropped us. And then we're trying to find someplace else to get insurance, and it's getting to be a really, really hard issue for our community out there in the boondocks in Southern California. Thank you.
Can you make her microphone work?
I'll just hop up here. So for insurance shopping, first thing is you're going to be looking at independent brokers, most likely. You're going to have somebody who's going to work really hard for you to find that, because they're going to have to run through, as Matt said, that list of 100 insurers. So, you know, contacting one of those, there's some resources on our website. The Department of Insurance has a really good tool for seeing who's underwriting, who's issuing policies in your area and who the brokers are. So go to that, go to this Department of Insurance site, hit the toggle that says brokers, and it'll show you who's handling business in your area. And I would contact all of them. So that would be the first thing. The second thing is, and it's a good point you brought up, the cost of the insurance, right? I'll be really frank. When I insured my house, I insured to value, like Roy said. It was really expensive. My husband, you know, we were near divorce on the price of what I wanted to pay for insurance because I don't want to be underinsured. My deductible is $10,000. I'm not filing small claims for a water leak. I am filing for a catastrophic loss. And that brought my coverage down to about $200 more a year than I had been paying previously before I jacked it up. So you're going to have to do some things. There's a lot of resources on our website to walk you through that piece. But it's hard. It's a really hard market right now.
And I'll point, United Policyholders is one of the best organizations, not just in the state, across the country, of helping work with folks. It's complex. It's not easy. And I won't make any pretense that it is. I think that's why organizations like United Policyholders are so important. We don't always agree on policy pieces, but I'll tell you, on the consumer side of the equation, there's no one better.
So this question is for Matt. You mentioned you did research in 2022 regarding how the most high cost is in insured that has high wildfire risks are for people that have higher incomes. You know, in Northern California, where it's much less densely populated, we don't see that. We see a lot of folks, like Eric mentioned, on the reservation that are limited incomes, retirees. They just don't have the money. There's no jobs out there. So where did you, what was your end, right? How many homes did you look at, and what areas did you look at? And do you separate, you know, Southern California, which is wealthier than rural Northern California and Oregon?
Yeah, that's a great question. So this was a study of the whole Western U.S. And what we found is that, to your point, so homes and households that are higher income are more likely to be in high hazard areas. But those areas, those households and homes are clustered together very densely in places like Southern California. And what you see across a lot of the rest of the Western US is relatively low density and also lower income populations in those high hazard areas. So both of those aspects are important, yeah.
Yeah, we've got less than 2 minutes. I'll just stand up here, sorry. Next question, but just to answer that, a lot of people are going bare because of that, so they're not being picked up by having insurance issues and costs.
Hi, I'm with the city of Malibu, and we've heard different things in terms of people actually getting a discount on their insurance if they do their home hardening, if they're a Firewise community, because, you know, in the literature it says you'll get a discount, and then we hear from, say, local insurance agents saying that's not going to happen.
There's no mandate right now, as Roy said.
I'll go
they're
farther.
coming, yeah.
An insurance company cannot give you a discount today until the insurance commissioner approves those rate filings. That's the first thing. It's coming, but they cannot give that discount to you. I think what most consumers are going to experience is the cost of insurance, wildfire notwithstanding, is on its way up. And so that discount is going to defray some of that increase. But the inflationary pieces, the other elements that are driving up the cost of insurance, aren't going to somehow be set aside by that. It's going to turn into defraying the rate of escalation.